There is a big shift taking place in alternatives right now. I'm starting to see investors who are fully capable of writing six-figure checks getting shut out of quality opportunities because the best sponsors, and I'm talking about the best ones, they prioritize groups, family offices with coordinated capital over solo investors every single time. Now, if you'll give me the next few minutes, I'm going to show you the data on why this shift is happening and how sponsors are starting to allocate their best deals and why family offices and groups are getting first priority while these solo investors are being left out. Hey, my name is Kent Leach. I'm the founder of the Smart Flex Fund. That's where I invite accredited investors to invest in alternatives alongside me. I've grown a couple businesses now, and I'm absolutely blessed to do this full time alongside other savvy investors just like me, LPs, right? Looking to diversify our portfolios into alts. And here's what I see happening almost constantly with other business owners like me and professionals who want access to quality, the best alternative investment opportunities. They have the capital and they're accredited investors, so they qualify, but they keep hearing about these great opportunities and deals after they've already closed, or they only get to see what's left over after these institutions and groups have picked through the deals. So, well, how do they solve this? They figure they're going to go network more. They're going to attend investor conferences in person. They connect with sponsors on LinkedIn. They're trying to build relationships one sponsor at a time. And they think if they can just get on the right distribution list, they'll start seeing better deal flow. But it's still limited to only the few sponsors, and usually mediocre sponsors, that they've connected with. And here's what the data shows. That approach keeps you watching from the sidelines, and it keeps you from actually getting in the game. Now, here's one thing we know for sure. It's who gets the first call when quality opportunities become available. Now, let me explain the actual mechanics of how and why sponsors are now allocating their deals differently. The best sponsors, again, we're talking about quality sponsors, typically have limited spots in each alternative investment opportunity. They probably already got a family office or a large group that they have on standby. Now, a multifamily syndication might have room for 5 million, 10 million in investor capital. Oil and gas, maybe even smaller, maybe 3 million. These best sponsors have to decide who gets those limited spots. And there is an allocation hierarchy they follow, and it's based on efficiency, reliability, and experience. First priority is always typically repeat investors that they can trust from previous deals who've proven they'll wire the money when they say they will. Priority two now has become these investment groups, family offices with coordinated capital. They can fill large allocations with a single conversation and a single check. And last is the individual investors, new investors who are going to need a separate call. They're going to need to have questions answered. They're going to need separate emails for wiring instructions, ongoing communication. And if a sponsor needs to raise, say, 2 million, would they rather have a conversation with a group that can write a check for the full amount, or would they rather have 20 separate conversations or pay an investor relations person to have those with these individuals who need to review the deal independently? You guessed it, the group gets the call first every single time. And if the group fills all the available space, those individual investors are never even going to hear about the opportunity, or worse, they're going to get left out. And this is starting to happen way more than you realize, especially on the best deals. So here's what this means in practical terms. First, you got to open your eyes and understand what's going on. You got to understand that sponsor allocation is changing. It's following a different system. The groups with the established track records and the coordinated capital, they're getting first access because they represent reliable, efficient capital deployment. You must acknowledge that group investing creates structural advantages way beyond just access. Groups, they can negotiate better terms because they're coming in with that larger check. They're going to get lower fees, better equity splits, and often priority allocation in some oversubscribed deals. So, that being said, what's the only thing left for you to do? You have to position yourself within an established investment group that already has access to these best sponsors, relationships, and execution history. So instead of spending hours building individual relationships with mediocre sponsors, you immediately benefit from the group's institutional positioning. It isn't rocket science. Sponsors want to work with capital sources that they trust and they know will make their job easier. And an investment group that writes big checks and has successfully closed deals with that sponsor before, they've proven already that they're reliable. The sponsor knows they'll execute, they're going to wire the funds on time, and they won't create unnecessary complications and bog them down. A new individual investor is a total unknown and could be a potential headache. So even if you have the capital to stroke that six-figure check, the sponsor doesn't know if you're actually going to carry it out and actually close and wire the money on time. So you simply get shuffled down to the bottom of the hierarchy. Now, here's where the group versus the individual concept really matters. As a solo investor trying to build one relationship at a time, you're waiting for sponsors to give you access. You're in a really bad position. You're hoping to get invited to the opportunity. But as part of an established investment group, you're seeing more deal flow. You're evaluating opportunities that sponsors bring to the group because they want the group's capital. So you've essentially moved from hoping for access to getting to pick and choose which deals to deploy your capital into, along with your new friends. That's the difference between being invited to the party and sitting alone at home. It's the difference between solo investing and group investing. And here's the other piece that really matters when you think about it. When I put together alternative investment opportunities inside my Smart Flex Fund, my money goes in right alongside yours. Now, this isn't me referring you to deals. I'm not bringing dozens and dozens of deals that I'm not willing to invest in myself. Now, have you ever heard of the skinny chef rule? It goes something like this. Some people joke that they wouldn't eat at a restaurant where the chef is, let's say, fit, because it's obvious he isn't eating his own food. So typically you wouldn't trust a skinny chef. And you shouldn't trust a hesitant fund manager that's not investing with you, or a sponsor that's not putting money in their own deal. So if I'm not willing to put my own capital in the deal, why would I ask you to put yours in? And you still can pass on any deal I invest in. So now you see why group investing isn't just about pulling money together. It's about accessing the deals in a way that's going to give priority to your capital as well, so that it benefits you, you as well as everyone else in the fund or in the group. So I hope this video has opened your eyes to a brand new way of investing. If you want to learn more about my Smart Flex Fund, just comment below and let's jump on a 15-minute call today.